Thanks for joining us today for our weekly investment update that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll start with a new feature that we've recently introduced to our market commentary each week, and that is a chart of the week. Hopefully, these will be relevant and topical. This week, we're comparing long-term investment returns for the S&P 500 index, corporate bonds, treasury bonds, gold, treasury bills, and inflation. We wanted to show this given the market volatility, just to remind investors that the risk of near-term volatility has historically been well compensated in excess returns. Note that stocks have been easily the most volatile asset class, but they've also returned almost double of the next closest asset class. For each incremental level of risk one takes as an investor, they should expect to be compensated, and that's historically been the case. You can even see the relationship holding when you compare corporate bonds to treasury bonds. So, corporate bonds add an additional layer of default risk, and therefore, investors have been rewarded with a somewhat higher return. Just a PSA here that the relationship between risk and return isn't just an academic exercise, it's something we've experienced here in the wild. So, turning to market action so far this year, we can see that despite a strong rally last week, domestic large cap stocks are still down about 8.5% for the year, and small caps are down over 16%. International markets have seen some downside lately, but have still performed better than domestic markets. Bonds corrected somewhat last week owing to rising interest rates, but still sport a positive total return in 2025. We continue to believe that investors will be rewarded for diversification in the year ahead. Now, the backdrop on trade is shifting quite quickly with new announcements. Most recently, reciprocal tariffs were paused, but tariffs on China were boosted to 145%. China's the third largest import partner for the US. Because of that, the implied tariff rate on US imports would still be almost 35%, assuming nothing changed in supply chains. Of course, that's unrealistic, but it does show that there's still a pretty major tariff headwind out there. Now, the announcement of exclusions on certain tech items from China would help carve off about 80 billion in tariffs, but those goods may end up with their own tariff schedule in the weeks ahead. So, to be determined there. Now, owing to all of the uncertainty, last week we got an update on small business confidence. It saw a relatively large decline, still holding some of the post election gains, but the direction of small business confidence could be a major headwind. Remember, small businesses employ a large share of the workforce. We would be concerned if the negative sentiment resulted in layoff announcements. So far, layoffs have remained low, so this is just something to watch for now. We also got an update on consumer sentiment. The Reuters University of Michigan Consumer Sentiment Index has fallen to approximately pandemic levels. Historically, this sharp of a drop in consumer sentiment would be consistent with almost zero economic growth. We'll get retail sales updated here later this week, and that may be instructive for whether consumers are actually cutting back in light of their deteriorating sentiment. What was somewhat concerning in the poll, consumer inflation expectations soared to 6.7% over the next 12 months. That's the dashed orange line in the top clip here. The blue line in the top is realized 12-month inflation. So even though inflation has been moderating, expectations owing to the trade policy are skyrocketing. Typically, falling business and consumer confidence with softening inflation trends would support a Fed rate cut, but there remains a significant uncertainty over the tariff impact to inflation, as evidenced by consumer expectations. That is complicating monetary policy here. Now, probably the most important driver for stock investors is corporate earnings. Earnings season is off and running, and when the dust settles, analysts expect S&P 500 companies to grow earnings about 7%. That's a solid number, but trailing earnings will likely matter less than forward guidance. We expect companies to lower guidance or even pause guidance altogether. The degree of the downgrades to the rest of the year earnings could end up being a major factor over the next several weeks. Valuations are still relatively high, especially for large domestic growth stocks. Now, in the very near term, it's notable that stock market pessimism reached levels that have previously marked the beginning of some powerful rallies. The orange line in the bottom clip of this chart aggregates a number of investor sentiment indicators into one indicator. Pessimism reached pandemic extremes recently. We would expect a strong rally to form from a pessimistic extreme like this. Now, we showed this illustration here last week, and it's a stylized version of market prices in blue and the percent of stocks making new lows in orange. We think we're through phase one of a major correction, that initial decline. The market has likely moved to phase two, which is typically a solid rally attempt. We would expect another corrective phase, though that should retest the previous lows before moving to the phase four breakout. So for now, our best guidance is that we're in the phase two rally. History may rhyme, but it rarely repeats exactly. So rather than being stubborn over the historical patterns, we'll watch objective indicators like this one shown here to give us the all clear signal that the market is moving back into a sustainable uptrend. In orange, this chart plots the percent of stocks above their respective 50-day average price levels. Within that percentage, whenever it gets to 90% or more, that's historically been a great indicator that the next 12 months will likely be positive. This indicator is not yet close to being bullish. Some closing thoughts for the week. Yes, markets are volatile and uncertainty is high, but historically, investors have been rewarded for taking these risks. Tariffs remain a significant headwind despite some changes to the framework. Uncertainty is driving business and consumer confidence lower right now. That is something to watch. And inflation expectations are rising meaningfully, which is complicating monetary policy for the Fed. We think we're still in a bottoming process, but we'll remain flexible. If high confidence indicators flag the all clear, we would take those messages seriously. As always, thanks for joining us this week, and we hope you have a great week ahead.